Hey everybody, welcome back to Click Capital, your go-to channel for the latest technical and fundamental analysis of the markets. And not so fast, say the Republicans, as they storm out of unreasonable debt ceiling talks with the White House today. It was only the last couple of days that we got good progress on this, with both sides saying that they will make a deal. However, that looks to have reversed course a little bit here today, as the Republicans branded Democrat demands as unreasonable, and Kevin McCarthy said talks were on pause. And the dispute between the two sides appears to be growing. We've got Republican Congressman Garrett Graves saying, look, they're just unreasonable. Unless they are willing to have reasonable conversations about how you can actually move forward and do the right thing, we're not going to sit here and talk to ourselves. So as much as the markets are pricing in this is definitely a done deal, this still could come down to the wire the last day or two, or maybe even spill over a few days into a technical default before they actually fix it, which would cause a lot of nervousness and volatility in the markets. And that did cause the markets to come off a little bit here today. We got mega cap tech flat with a little bit of down moves in NVDA and Amazon. Financials came off a bit as well, but energy held up, and a few other defensive sectors like healthcare, utilities, and packaged goods companies had a little bit of an up move here today. And that was in the face of Jay Powell commenting today that stresses in the banking system mean the policy rate may not need to rise as much as previously expected to tame inflation. He went on to say that developments in the banking sector are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. However, there's still a lot of people skeptical of those claims because, like this economist says here, the Fed may be forced to defy market expectations and hike more aggressively. And that's because inflation appears to be sticky and we still do have a tight labor market. And even Goldman Sachs CEO disagrees with the markets as well on rates and inflation. He said, I personally think inflation is going to be a little bit stickier, and I haven't been in the same place as markets have been about a decline in rates as you go into the end of 23 into 24. And his forecast of sticky inflation is in addition to a May survey of CEOs that found 93% of CEOs still report they are preparing for a US recession over the next 12 to 18 months. But with those comments from Jay Powell today, the Fed Fund Futures market decreased their probabilities that the Fed will hike next month to 17.4%. And even though we got the debt ceiling talks stalling and markets came off a bit, the Fear and Greed Index actually ticked up 1 point to 67. And that's in large part due to the enormous call buying still going on today. So we had a busy day, as is typical on Friday in the options market. 42.8 million contracts changing hands, 55% of them calls. And you can just see up here in the put percentages how low they are for Tesla 37, NVIDIA 42, Amazon 39, Apple 38, Google 31, Meta 27. So there's just record amounts of call option buying still going on in this market. Dark pool buyers are still active as well, with the DIX climbing again here today to just under 54%. And it's this indicator here that's preventing me from getting too net short, as dark pool buyers do have a good track record of timing the market as well as corporate insiders. But in contrast to the dark pool buyers are the corporate insiders, which are still outpacing purchases 210 to 132 yesterday. And even though stock market valuations aren't that extreme when compared to themselves, when you compare it to the safety of government bonds, they are expensive. And Ned Davis Research explained it in a good theme of a decade of TINA being there is no alternative to equities. To markets have transitioned to TARA, there are reasonable alternatives. And we can see that here in this chart of the SP 500 earnings yield minus the government US 2-year bond yield, which is currently at the lowest it's been since this whole bull market started after the GFC, and was only really eclipsed back in the late 90s, early 2000s when stocks got way ahead of themselves and we saw these huge crashes across the markets, with the NASDAQ coming down 80% in this period. And then equity risk premium came back into the market, especially in a big way in 2010. There was much more premium to be earned being in equities versus bonds, as bonds had been ultra low, which in turn helped fuel the rally in equities, but all that premium has been lost now. Also helping to fuel the everything bubble over the last 15 years was the Fed's balance sheet, which before the GFC was under $1 trillion and had gotten up to almost $9 trillion in the middle of last year, but the Fed is trying to decrease that. So the low rates and the huge explosion in Fed quantitative easing and just pumping liquidity into the system has all come to an end. So the returns from stocks going forward for the next couple, 5, 10 years can't be expected to be as good as we've experienced over the last 10-15 years. And in my opinion, it's these two men, along with Janet Yellen, who have presided over the Fed whilst they exploded their balance sheet higher, accelerating wealth inequality. And that's the gap of the share of wealth that the top 1% has steadily increased since the Fed has blown up their balance sheet, and then the wealth held by the bottom 90% has steadily decreased since then. And again, in my opinion, has caused a lot of the problems that we see into society today, that the elite and media try to mask by baiting us into a race war when really it's a class war that they don't want, as they're the perpetrators of that. Also causing the banks to fall today was a report from Treasury Secretary Janet Yellen that she told bank chief executives that more bank mergers may be necessary. And unlike most mergers, the company that is getting acquired tends to take the biggest hit, with the equity and bondholders being on the hook and the acquirers making out with the biggest gains. And we can see how evident that is in the chart of First Citizens Bank shares, and they overtook Silicon Valley Bank back here. And the day before they did that, their stock price was trading at $5.82 a share. We're now more than double that, up at $1,300 a share. So that's been a complete wealth transfer from the equity and bondholders of Silicon Valley Bank over to First Citizen Bank shares. And just another look at how different the top end of the concentrated market is valued. We've got the top 10 stocks, the S&P 500, with their current PE ratio at 26. And that's 130% of the average of 20, with the remaining stocks much lower at 15.9. You can see that on this chart here. And again, another similar pattern to the tech bubble crash, when valuations in the top 10 went sky high and then came crashing down with a little bit of a bumps up on the way. So this could be another similar pattern, and the reversion to the mean when they both come back in line to the same valuation as the bottom 490 stocks in the market. That pattern could be taking place again, but as we see in the options market, a lot of people are betting that the top 10 stocks are going to continue growing much more than the rest of the market. But even now, the top 10 stocks are making up almost 29% of the market cap, and that's even higher from the peak of the tech bubble back in 2000. And even though the earnings of the top 10 ballooned after COVID and everyone staying at home, affecting more old economy stocks than the new economy tech stuff, their contribution of earnings to the S&P 500 has reverted back to the mean already, and is in line with most of what we've seen over the last 20 years. And no chart shows that better, and the everything bubble, other than the NASDAQ, which from the GFC, when the Fed started pumping extraordinary amounts of liquidity into the system until they just stopped a bit over a year ago, the NASDAQ climbed up 1,550%, and still today from that low is up more than 1,200%. And going back in all of stock market history, this is one of the biggest advances in a 15-year period, and typically when you see that, there is a big reversion to the mean. And that trend is exacerbated in some of the most loved areas of the market, like NVDA here, on the back of all the AI buzz and hype. And we can see that too is approaching its all-time highs and could be setting up for what could become an epic double top. And with earnings out in 5 days, we'll be watching closely how the market reacts to that. International stock indices were a little flat here today, and we saw a little pickup in volatility here today, especially in the main VIX, just up 4.8%, and the back end as well. Volatility had a bit of a spike up here, and that put call ratio ultra low at 0.81, so people still piling into call options. And the breadth is just not there in the market. 46% of stocks above their 20-day average, still less than half of stocks above the 50 and above the 200 too. Bit of a pullback here today in the growth sectors versus defensive sectors, as we've been a bit overstretched, but the growth versus value trade still looks to be in this parabolic uptrend, so still too early to say that this is topped out. And contrasting most of the theme across markets today was high yield outperforming treasuries and back above the 50 on the spread chart. There's the government bond 2-year yield holding steady at 4.27, and the 10-year found new highs today to 3.70, so that's broken out since it's been in this channel after Silicon Valley Bank collapse caused the rates to come down a lot. And so rates look to have stabilized along with the price action in regional banks. December Fed Fund futures found new highs to 480 as the market continues its U-turn on saying the Fed is going to cut rates later this year. TLT found new multi-month lows today, but is in oversold territory. We can see that it's now below our lower buy-sell band. And on our range strength indicator, we can see the market is trading sideways. So I do expect it to find support around here and maybe down to 100. Dollar pulled back a little bit today on the debt ceiling talk stalling. Bitcoin holding up just under 27,000. Commodities overall still sit in a major support zone, and with that nervousness out of the government, gold found footing here today up 1.1%. Crude hanging in there at 71 a barrel. And just looking at stock sectors out there, a bit of red in the growth stuff, especially retail is the big loser today, down 3.5%, coming close to year-to-date lows. And the winners were the energy, biotech, and gold miners, along with other defensive stuff, healthcare and staples and utilities just flat off a little bit. Tesla had a good day, closing above its 50, up almost 2%. The video stalled out a little bit here today, and we've got earnings coming out on Wednesday with expectations that they've made 92 cents a share. And it'll be interesting to see how the market reacts to earnings, because we're almost at an 800 billion market cap with a trailing price to earnings ratio of 181. So just looking at this price action, you could say the market is expecting really good numbers to come out, especially with guidance. I'm sure they're going to hype it up with lots of mentions of AI. And last earnings, they actually beat by 8% and the market gapped up and finished 14% higher. But the day before earnings, we were trading at 207 a share, now at 314. So we've gone up over 100 points in just a couple of months. And there is a lot of optimism baked into this stock, so the expectations are big. Apple actually found new year-to-date highs today, but closed near its lows. Amazon put in a bit of a dark cloud cover candle formation here, up in really overbought levels, along with other mega cap tech as well. We got Google here with a shooting star formation in overbought levels. AMD with an inside bar, and Netflix pulling a bit back here as well. And so mega cap tech and the NASDAQ as a whole is pretty stretched up here, technically speaking. We can see on Wednesday, we actually put in a DeMark 9 count, which signals the exhaustion of a move and saying we're a bit stretched here. And you can see last time we did a 9 count was back on Feb 1, just a day before we topped out on a bit of a swing high. And then before that was back in August. Last year, we didn't quite get to a 9 count. We got to an 8 count about a week before another big down move. Then prior to that, we got the last 9 count in March 22, which was a day before the top. So we are technically stretched up here, and a lot of people are buying calls on these tech stocks. And that's typically a contrarian signal. And meme stocks got a hit a lot harder here today with a bit of red across the board in the space, especially with the AI stuff. Big Bear down 8.6% and C3 AI down 5.7%. We had Deere come out with earnings today, and even though they beat and gave pretty good guidance, the market gapped up, but there were big sellers just waiting for those prices and sold it off hard, actually finished down near the lows. And retail continues to get hit hard, and just showing here today in Foot Locker, they came out and only missed by 8.3%, but they significantly lowered their guidance going forward and just got absolutely whacked by the market, down 27%. And we're seeing similar price action in other big retailers like Walmart coming down, Target coming down after their better earnings. And going into earnings next week, Best Buy coming off 3.4% today. Ulta Beauty down 4.3%. And online retailer Etsy finding new lows for the year, down 3.5%. And this is a stock me and my clients have been short since 120 after earnings back up here. And we continue to remain short on this thing as we still think it is really overvalued. And with unemployment at all-time lows, 3.4%, and retail's already struggling, it makes you wonder what's going to happen when we see the recession to retail. And I think part of that is because we've got credit card debt just below $1 trillion, and that's absolutely skyrocketed since COVID. Since the government handed out all that stimulus and we had ultra low rates, but now we've got really high rates, the cost of servicing that debt is at all-time highs and looks to be staying there, if not maybe going higher. So just imagine what happens to the economy with credit card debt at all-time highs, servicing that debt at 15-year highs, and then if millions of people start to lose their jobs with all that debt, that's not going to be good for the overall economy, especially the discretionary spending retail space. Carl Icahn looks to be struggling to win the war against the short sellers and Hindenburg Research, with his stock falling 7% today, even though he authorized a buyback of $500 million worth of stock that looks to be doing little to stem the bleeding. And here's a quick look at the vulnerable regional banks after Janet Yellen came out today and said more mergers are needed to be done. They're kind of just still hanging in there. Still got big banks, Bank of America and Citigroup underneath their 50, Wells above it with JP Morgan, and Schwab just still hanging on to its 50 here. Okay, over to our final outlook on the market. So the SP500 did find new highs for the year today, up at 42.12, but did pull back and close underneath yesterday's close. And so we've got mega cap tech really overbought up here and holding that market up. But we've got a lot of divergences in the market, and we can see that with the global net liquidity model. Now almost a 400-point gap. And other things like breadth, junk bonds, copper, and just most stocks continue to trade weak, if not sideways at best. However, with dark pool buyers hanging in there and the main indices edging to new highs, I don't want to fight it here, so I'm keeping market neutral going into next week. And I would say the market is expecting a debt ceiling deal to come out next week as the clock is ticking down to June 1, when it's expected the US government could run out of money to pay its bills and all chaos breaks loose. So if we get any more stalls on the debt ceiling talks next week, I can imagine volatility will start spiking and the market should pull back on that. However, it could still be a bit of a clown market if they do come out with a debt ceiling deal, and then the stock market might rally off that. So I'm just going to wait and see before getting net short again. And that's all I've got for you this week. Thank you to all you guys who tune in and support the channel by hitting the like button. I really do appreciate that. I wish you all a great weekend, and we'll see you again on Monday afternoon.